Okay, welcome back. There's 4 minutes to go for the pre-open session, but it's time now for a CNBC-TV18 exclusive, and this is a mega one. JP Chase's chairman and CEO, Jamie Dimon, talks about India's potential entry into global bond indices. He says bond index inclusion will be a sign that the economy is growing and getting bigger. He also tells my colleague Shireen Band that India could be a huge beneficiary of China plus one strategy for manufacturing. Listen.
Absolutely, you should ask me, you should fight for it. And I can't get involved in that because research is independent. So by law, but if I was India, I absolutely would be part of it. And if I didn't get in, I'd ask why. And then I try to accomplish those things, get in. And so I'm hopeful for you. And it is a sign of a country, coming, growing and becoming bigger and better well known. And once in indexes, the other thing it does for you, it's always out there, so you can get you get a lot of foreign direct equity investment. This time you get also foreign direct credit investment. And you have people like America who want to be your ally and partner in many more ways. And then I think you have a little bit of a gift. This is not what I'm about to say. Is not anti-Chinese, but as every nation looks at and every company looks at supply chains, they're going to have to diversify more. And a lot of people say China isn't as secure a supply chain and therefore have to move manufacturing to somewhere. And I think India could be a huge beneficiary of that. You got to make sure the rules are right, and the regulations are right, and the capital is treated right. And I talk about rules and regulations, I'm talking about rule of law, bankruptcy law, tax code. If you get those things right,
Okay, you can catch highlights of this conversation all through the day only on CNBC-TV18, so do stay tuned in for that. But just waiting for the pre-opening rates to kick in. By the way, just wanted to mention that one of the stocks in focus today could be KPIT Technologies. They announced an acquisition just a while back of Technica Engineering, which is a company that's into the automotive space. They specialize in prototypes, architecture, hardware for the automotive sector, and this is an EPS accretive acquisition. Post the acquisition, the company will be EPS accretive for KPIT Technologies. It's 100% cash consideration, and 80 million euros is what they will be paying for this particular acquisition. Just keep an eye out on KPIT Technologies. But Devin Choksi is with us. Devin, some of these mid-cap IT companies, of course, they've fallen quite a bit, but continue to indicate that demand is strong. There's no cooling off of client spends, and they're making acquisitions as well. Case in point, KPIT Tech. Would you buy any of these names now?
Yes, Samir. I think the correction in the price is definitely welcome. I think we've been waiting for this kind of correction. I think the companies which are operating the niche segment like LTTS or LTIS, Mindtree combination, or even for the better Tata Elxsi, though it is expensive, I think this kind of companies remain, I think, extremely strong candidates. Even I think you mentioned KPIT, the pure focus auto company, I think as you can call it as. I think such niche players definitely, when the price correction takes place in the market, I think they offer an opportunity. As discussed earlier, I think we remain fully convinced about the prospects of IT going forward, and believe that some of the mid-tier IT companies, when they come down on the price and I think the valuations become attractive, it's time to buy into them. I think we do believe that I think they would probably produce growth more than some of the large peers, I think, that they have in the space. And probably, I think, around 25 plus kind of a growth can be expected out of these companies. So remain positive on some of these names as far as our portfolio is.
All right, Devin, we let you go on that note today. Thanks a lot for joining us. Have a good day. Appreciate your time. We have our next guest joining us. One sector which has been in a bear market this year after a 3-year bull market is IT. Ankur Rudra is Executive Director, Technology and Telecom Research at JP Morgan and has, of course, tracked this sector for a really long time. Ankur, good morning. Thanks for joining us. Last quarter, the big chatter was just about margin and valuation. This time, I was reading that perhaps there would be concerns on top line itself. Are things looking really that bad, or is it still largely about margin? Your view on the IT stocks now?
Thank you, Anuj. I think this year, clearly, we have a lot of challenges for the IT sector. We began with some concerns about the demand back in May and June, when there was the first signs of macroeconomic weakness. And then, of course, like you said, there were margin pressures that every company has faced. I think with some of the negative surprises on inflation we've seen in the West and some profit warnings by leading global companies, the concern on growth and demand has really come back. Our perception is that so far the IT services companies have not probably seen this on their top line yet, perhaps not even on their order booking or signings. But the more leading indicator is the pipeline. And we think they'll begin to see this maybe in a few quarters out. Now, remember that IT services companies are late cyclical. So it might be some time when they reflect the current macroeconomic scenario. But from a conversation perspective, we are equally worried about the top line and the margins.
You're equally worried about the top line and margins. So Q2 earnings season is upon us, Ankur. Do you expect any change in the margin guidance from some of these large cap companies like Infosys?
I think, both the last 2 quarters, we've seen very significant margin misses by a range of companies. Last quarter, I think, was an interesting quarter where every large cap IT services company missed their margins and margin expectation by a significant, percentage. This time, perhaps, on a sequential basis, we don't expect that. I think there is an expectation that in general margins for the sector, may not worsen significantly. But the real point is not, what happens sequentially. The real point is how long can these companies keep these very low margins? How long will it take for them to recover margins? And I think that's an important debate. Can these margins be recovered significantly? Can we go back to the margins of 2020, margins of 2021? And that's where we think there is a lot more structural pressures on the margin, both from the significant cost inflation that the sector has seen on offshore employee base, especially the younger employees less than 5 to 6 years of experience, on a very high US wage inflation, which is in many cases about 5% versus 2% for the last 30 years, and also returning travel cost and facility cost. So maybe not so much incremental margin pressure on a sequential basis, but the chance of margins to recover from here, let's say for F23 and F24, that's where we remain very, very concerned.
Okay, Ankur, since you did mention 2020 and 21, what about valuations? Because margins are back to pre-COVID levels, but valuations are still 35-40% higher compared to that. Do you think more reset is needed?
I agree. I think so. I agree with you. I think valuations remain very high, especially if you look at the long-term averages pre-COVID. We're still above 20 to 30%, like you said. I think that's the challenge with the IT industry right now. There is a potential for, there's an earning risk from demand, like we discussed. There is an earnings risk from margins, which might take much longer to recover. And valuations remain very high. For a significant proportion of the companies, especially some of the large companies, many of the mid caps, valuations remain significantly high. And given we are going into a period of macroeconomic slowdown, we don't know how long that will be. This doesn't seem to be a great time for the sector. So I think we remain very concerned on valuations as well.
Ankur, hi, good morning. Prashant here. Have any of these companies presented at your conference, or are they, Ankur?
We have a lot of tech companies, tech services companies at our conference. Tech services companies haven't presented, but a lot of companies have been participating in our conference.
Okay, sure. No, the reason I say that because there are a lot of other conferences happening, and I was reading sort of what Infosys, for example, said a couple of weeks back at at a Credit Suisse event, and TCS recently, did something. The general indication seems to all of them are saying that large deal momentum remains pretty strong, right? There has been really no postponement or anything like that. There was another comment that I read from one of these companies to say that, well, if you're going to see a postponement, it's largely going to be in the hardware segment, servers, etc., because that's easy to postpone, not software services. How do you kind of respond to that? And have you heard that kind of pushback from companies themselves? Your sense?
Sure. So thanks for the question. I think it's very interesting. I think what we think about is, the relative cyclicality of different segments of tech spending. There is hardware, which tends to see the impact of a macroeconomics weakness first. There is enterprise software. We've seen a lot of enterprise software companies already, giving out profit warnings in the last few weeks and months. And then there is services, which is is probably the most late cyclical of all of these three, where they see an impact after the hardware industry sees, and after the software industry sees. So in a way, for us, from when I think about this, for me, I think hardware softness and slowdown is basically the first leading indicator that tech spending will get impacted. Like I said before, I don't think that any of these companies are seeing it so far, because if there is weakness next year, they'll probably see it closer to then. I mean, if you look at the last 4 downturns, IT services companies have taken a long time to perceive this. But that doesn't mean that it may not happen. So we remain equally concerned, despite in the short term, companies not seeing it. And in fact, we were expecting second quarter to be a relatively strong growth quarter. We'll have to see how these companies perform in Q3 and Q4, which have been traditionally relatively soft quarters from a seasonality perspective.
And will the Accenture numbers this week kind of be important to track, to gauge? Whether this softness is coming through or not, or you think?
I think so. I think.
Yeah.
Okay.
Go on.
No, I agree. I think Accenture numbers are very important. And, there is the guidance that Accenture gives for the August ending year for next year. I think that's an important metric to track to get a sense of incremental demand. There's also very important to see where the bookings are for Accenture. So it's important for the industry. Having said that, Accenture has been growing a lot faster than almost every IT services company of scale in the last 1.5 years, except maybe one company. And hence, even if Accenture does do really well, we'll have to see if it comes from consulting or technology outsourcing, and how much of that is relevant for the Indian IT companies.
I just had, a couple of more questions, if we can squeeze them in, Ankur. Stocks like Tata Elxsi have had a dream run, and despite premium valuations, these stocks are still up about 50% year to date. You have an underweight on that stock. Just want to understand, do you think that the trajectory will continue to be northwards from here, despite all the challenges that we've seen?
I think I can't comment on stock specifics, so won't be able to comment on one company. But what I would say is, from a fundamental perspective on the engineering, research and development sector, there are two things about the sector. It is probably going to grow structurally faster than the broader IT services space because it's less penetrated and there is a huge amount of digitization. And also, they're also very cyclical. So if there is a slowdown, they might get impacted faster. You might see an impact perhaps in F24, perhaps in CY23. So those are the two interesting factors about the engineering services companies which you'll have to contend with. And if some of these engineering services companies, I think most of them on an average, are a lot more expensive than the broader IT services peers to bake in the long structural story. So if there is a slowdown, it could drive a significant negative, surprise on earnings.
Ankur, one last question from my side. Did the recent FedEx stock fall and the warning from FedEx sort of also come into a picture in terms, because that's a large sort of company in terms of what the US economy is doing. I believe it's also a client for a couple of large IT companies as well. Any thoughts here?
I think the FedEx warning is interesting, like you said, because about what it says about the nature of demand and nature of spending. It could have a ripple effect on the IT services companies it's a client of. So I think both of those factors are important. I mean, from us as an outsider, we just definitely view this as a potential trigger. So like I said, there have been profit warnings in software and also profit warnings in many clients. This is clearly one of the clients which is warning. So we would be concerned about, to an extent, the tech spending at clients such as this company. We'd also be concerned about how this spreads because we've seen some profit warnings come through, and that would be probably a source of worry. It also depends on how that particular company is choosing to decide between outsourcing companies and non-outsourcing companies in deciding to look at and realign its tech spend.
Ankur, always a pleasure to talk to you. Thanks a lot for joining us, and have a good summit in Delhi. Thanks for joining us. That's Ankur Rudra from JP Morgan. They have been negative on IT, of course. The pre-open has settled, by the way, 50 point lower on Nifty, so not as much as the STX Nifty indicated. The mid-cap index is actually opening in green, and the bank Nifty is down 185. So Darshan, if we open here, do you trade the Nifty or wait for that dip? And what's your 9-10 call?
So I still wait for a dip. We just raised the level of 600 to 650. but it's much better to wait for a dip. I think we'll get it today. ONGC is a buy with a stop under 129.
Okay, ONGC is a buy. Yesterday's low, remember, was 17,744. So we're still opening above that, 17,766. Mitesh, what's your 910 call?
Buy on Cipla. Keep a stop at around 1,060. Look for targets 1140.
All right, thanks a lot for that. Well, let's talk about some stocks now. Plenty of them in focus, actually. SBI is on our radar. Abhishek is here to tell us why. Abhishek.
Well, Sonia, Jefferies has written on SBI. They have a buy recommendation. They have increased the target price to 700 from 630 that they had earlier. They said that the bank is well placed to ride the upswing in credit cycle that we are seeing. So they have raised the estimates of PAT anywhere between 3% to 5% over the next couple of years. So net interest margin, as per them, for SBI may remain range bound given the fact that corporate credit cycle will be picked up by SBI, and so the yield can remain under control. However, they expect healthy credit growth going ahead. So low credit cost will support the earnings momentum. So they expect ROA improvement going ahead. Bank needs to boost capital. It may not do via QIP, but it may do via stake sale in subsidiaries. So they have estimated an ROA of 1% and ROE of 15% for FY24 for SBI, and that is why they remain bullish on the stock. Back to you.
Okay, thanks a lot for that. The stock of the moment in the broader markets is Swaraj Engines. It's up 6.5% in pre-opening, and we told you why. M&M has acquired additional 17.5% stake in Swaraj Engines from Kirloskar Industries for 296 crores. Kirloskar Industries is also up about 7.5%. So with this acquisition, M&M will now have a 52.1% stake in Swaraj Engines. So effectively, Swaraj Engines becomes a subsidiary of M&M. Now M&M will take complete control of Swaraj Engines in terms of ownership as well as management, functioning, etc. And that's a big positive for Swaraj Engines, and hence that stock is up about 7% odd. As we know, Swaraj Engines manufactures diesel engines for Mahindra tractors. They've been doing it for years, and their growth has been pretty solid. In the last year itself, the revenues were up about 15.5%, and over the last 3 years, things have looked good. So all three stocks, M&M, of course, it's a minor positive, but bigger positive for Swaraj Engines, and even Kirloskar Industries, which is the holding company, is doing well.
Okay, the other stock which is looking interesting is Central Bank of India. That's up 15%. Now, of course, that's no longer a kind of stock that warrants an excitement. But the reason it's important is because it was the last remaining PSU bank in the PCA, prompt corrective action. That's also getting out. That is important from the economy point of view and also from the PSU banking point of view, because that's a space which has done well. We had Madhu Kela as guest editor telling us that the worst of the asset quality issues is now just behind the banking names and the PSU banks, and these PSU banks have done well. So that's something that you got to keep an eye on. But we'll wait for the market opening and see if the market actually defies the SGX once again. The Nifty is opening about 49 points lower, and the Bank Nifty about 200 points lower, and that's straight away cut to about 100 points on the Bank Nifty and just about 30 points on the Nifty. I mean, this is a market where this money is just sitting on the side waiting for dips. Any dip, small or big, gets bought. Just look at that. The Nifty is already in the green, almost. The mid-cap index Nifty is in the green now. The Bank Nifty is almost in the green. I mean, the SGX Nifty can do what it wants. The market just doesn't care. Of course, at some point, maybe it becomes risky. But for now, every dip, is getting bought. Auto stocks are doing well today. M&M, 1% higher. Eicher Motors, 1% higher. Hero MotoCorp doing well. Then, of course, you have a couple of other names like Bajaj Finance, also higher. By the way, the mid-cap index is surging. Apollo Hospitals is higher. Nestle, Sun Pharma, Lever, Cipla, Tata Steel, all these stocks doing well. SBI Life is higher in trade, but Mahindra is really your stock of the moment, at least on the upside in the index stocks. On the way down, again, Infosys is starting lower. By the way, this, I think, is a fresh 52-week low on Infosys, or very close to a 52-week low on Infosys. I think the 52-week low is 1367 or thereabout, and I think we are 1373, so very close to a 52-week low on Infosys. UPL is the other stock which is a bit soft. TCS and HDFC Bank also a bit soft. The market is still trying to bide some time, but suffice to say that the SGX Nifty was nowhere near what the actual opening is much better than the SGX Nifty, and the broader market is surging, Sonia.
You know, as we were saying earlier, right? I mean, the market is sort of moving forward from every cue, whether it's the Fed meet, whether it's the rate hike. There's just so much money that's flowing around. The mid-cap index is up about 160 points. The stock of the moment is Swaraj Engines. It's up 12% right now. It's hit a fresh 52-week high after M&M acquired additional 17.5% stake in Swaraj Engines. The other one is Triveni Turbine. That's up almost about 5.5%. All these are stocks that are in the news. You have a couple of other names. McLeod Russell has been moving with quite a bit of strength. That one is up about 10%. Cipla has been hitting fresh 52-week highs. In the broader markets, Patanjali Foods has been doing well. Would be interesting to see what Kirloskar Industries is doing, because not just Swaraj Engines, but Kirloskar Industries also in pre-opening was up about 9% post M&M buying the additional stake in Swaraj Engines from Kirloskar Industries. A couple of other stocks, Adani Wilmar is up about 5%. Keep that on your radar. You have Solar Industries that has been doing exceptionally well. That stock is now up 61% this year. KPIT Technologies has made an acquisition, so that one is up about 1.5%. Balkrishna Industries, some of these tire makers. So, you know, the list is pretty endless. The headline index is not doing too much, but the real action is beneath the surface.
Oh, absolutely. I mean, almost the market here, you know, looking at the Fed and saying Sanuki, right? I mean, it's just incredible. 30 points is what the cut is now. So a little volatile, but this is as flat as they come. So 17,780. Remember, yesterday also, you know, bulk of the activity and the up and down and all over happened in the first 40, 45 minutes, maybe an hour of trade. I mean, it was pretty volatile. And then, I mean, the market set a trend higher and just kept moving through the course of the day before coming off about 100 points towards the close. But it was still a very strong day. So we'll see. I mean, maybe a little too much to expect a similar kind of day today, but you can never say no in a market, the phase of the market that we are in, where little seems to matter. When I say little, I mean from a global standpoint. Just a couple of other things before I sort of bring in our market master of the day. So Adani Wilmar is up another 5% today. There is Yes Bank, which is starting 3% up. Central Bank of India is up about 11.5%. So that's another one which is doing well. Sonia mentioned Patanjali. Indiabulls Housing is up 2.5%. Triveni, Swaraj, etc. We mentioned Kirloskar Industries. We mentioned Butterfly Gandhimati is up 3.5%. That is coming up. There is Greenply. I think Greenply has got a sort of initiation or an upgrade from IIFL, I think. It's up 4%. Greenply, 202. Indian Overseas Bank is up 2, Torrent Pharma is up 2, and many others. Rate gain is up about 3%. So these are initial rates which are coming through. 4:1 in favor of advances. So it's a pretty comfortable kind of market breadth in favor of advances that we have going at this point. JK Lakshmi is down about 2%, just something on the downside. UPL is down 3/4, and Godrej Consumer is down about 1.25% or so. ACC, Ambuja, of course, are mildly lower, 0.5% and 1%, respectively. A banking name which has done so well recently is down 1%. IndusInd Bank, so 12.51 on IndusInd. I can name more stocks, but volumes there, not really anything to talk about. The market's back being flat. Just, actually come back almost into the green once again. So 17,800. 815 on the index. We have Tushar Pradhan joining us, Chief Investment Officer at HSBC Global Asset Management India. Tushar, great to have you with us here on the program. Thanks very much. So, I mean, first thoughts from on this huge run that we have going. Is it just a matter of kind of, tracking, not tracking, but because you can't really track flows on a day-to-day basis, but there seems to be a lot of money coming to the market here with a lot which is happening globally, other emerging markets falling off the wayside because of various reasons. We've been talking about that here on the channel as well. Your thoughts on the outperformance we have?
Yeah, so I think India clearly is a different market than most other emerging markets at this time for a lot of reasons. Obviously for the reason that we continue to remain a domestic focused economy. And our economy currently is showing all signs of pretty strong growth. And as a result of which corporate earnings are also slated to be pretty significantly higher than last year and expected also to remain strong in the next year. So the fundamentals are good. The problem always with the markets is not only just the fundamentals, but the external situation as well and the global environment. As we know, the global environment is a little suspect at the moment because of the significant up move in interest rates in the US led by the Fed. And that has given rise to some fears about an impending recession in the US. Some people comment that it may just be a matter of timing, but it is likely to happen. If that happens, obviously that is not good news for the global economy and obviously every emerging market linked to the economy, which is in the US as well. India, on the other hand, being a domestic economy, is slightly insulated from all of this. Of course, markets can never be insulated, but at least economy is the way they go. They are slightly insulated to an extent. But I think given all of that, the current up move is a combination of factors. One is that we've seen a significant outflow of money from the FPIs so far. But quarter to date, we are seeing almost upwards of $8 billion which have come in just in a matter of 3 months. And that clearly will have an impact on valuation. So I think it's a combination of the fact that the fundamentals look good, the money is coming in after a long hiatus, which is the kind of outflows that began in November of last year. So it's a combination of all of that, I guess. So we should enjoy it while it lasts.
Okay, we should enjoy while it lasts. Tushar, hi, good morning. So, since you referred to the domestic economy stocks, the sector of the last 1 month has been cement. Do you have, large exposure to cement names? And what's your view on what's happening right now? Is, this, of course, after the entry of Adani, the stocks have just got re-rated. Not just the Adani stocks themselves, but others as well. And the market believes almost everything will be acquired. But your view?
Well, cement has seen a significant cycle, I would say, because as we entered into the COVID period, clearly there was a significant loss of value because obviously all sort of construction activity just came to a grinding halt. On top of that, at the start of the year, we saw a significant increase in commodity prices, including coal and electricity and energy generally just went up through the roof. So the margins for this business, already battered by very low demand, was a significant dampener for these stocks for a long time. As we see, and as I was mentioning about the return of growth in our economy, I think there is a lot of pent-up demand, both from the construction housing perspective as well as infrastructure, which is likely to happen in the next few years as such. And as we see that because of this significant downturn in this industry for some time, there was a lack of energy in terms of adding to capacity. So we now have a situation where if demand comes back, we will realize that the supply that we have right now will just about be adequate. So we are talking about capacity utilizations going up. And as and when it starts to touch a 75 to 80% capacity utilization as an average across the industry, these companies start to get re-rated. I think corporate acquisitions and actions continue to happen from time to time, but that cannot be any lever for a sustained re-rating in the companies forever. It could come as a strong infusion of capital inside of the industry, which is making participants pretty happy about the overall situation. So I think that would be my take on that.
Okay. How are you approaching some of these other spaces like, say, mid-cap IT or IT as a whole? I mean, we were speaking to the analyst earlier on who said that, not only margins, now they're concerned about top line as well, as client spends might wane as they head into a recession in the US. What would you do with that pack now?
Yeah, so that's another interesting one because especially when you talk about mid-cap IT, it is a lot more stock specific than industry related. When we look at the large caps, obviously industry related headwinds are, the expected downturn in the US economy and then the likelihood of lower spending on IT, etc. We've been through this before, but I think throughout this period, I think the IT companies have delivered with only the sentiment going up and down. So I think here what you're likely to see is that since most of the IT businesses in India support mainline activity in the US, it is unlikely that unless there is a very large portion of discretionary spend in the whole IT budget, which gets lopped off and which are linked to our companies. I think without that, we will continue to see earnings grow. We will continue to see strong quarter-on-quarter accretion. However, as you mentioned, the margins have been suspect because of the rising costs, but that will plateau out at some point of time. And as we go into the next few quarters, I think it will become clearer whether the IT spend scenario that has been painted right now is likely to sustain. Given all of that, I think the call should be on valuation. We've seen mid-cap IT actually go ahead of large-cap IT by multiples in the last few months. There will be a period of kind of self-correction there, and markets generally tend to self-correct as well. But I think the mid-cap story is more to do with individual companies and individual growth vectors. So within that pack, I think one should look for significant, strong growth trends, which are unique to any one company. So I won't think that the entire pack is going to move together because the general headwinds in the sector are well known. But I think if there are any specific reasons to get excited, say for example, travel. There has been a lot of travel across the world, and we've seen a tremendous boost to tourism earnings. And software companies which lock into logistics or go into the transportation sector in some way or the other can expect a significant change in their fortunes, etc. So it's really more to do with individual companies at this point.
Okay, Tushar, a word on PSU banks. SBI has been the best outperformer in the entire large cap space.
Yeah, I think when you hunt for value, clearly there is a lot of relative value here. The debate always is that value something which is going to get re-rated, or will it continue to remain value? In other words, is it a value trap? Clearly, I think there is going to be a change in terms of how we view these businesses. Certain public sector banks, clearly with a lot of focus and tremendous management behind them, will take advantage of whatever the private banks have been taking advantage of. It is a competitive market. And if they come up with products and services which match the expectation of customers, the bank is a bank. It is part of a wonderful, vibrant economy that we have. So why should the PSU banks generally just be painted with one brush? So I think companies which are willing to take that initiative, companies which are willing to take that investments into the area where it is client-centric, I think you'll see a significant upside for valuation there. It remains to be seen whether that is to the expectation of customers, or for that matter, it takes away market share from existing private market players as well. But I think that's a space which is worth looking at. And I think clearly some companies are ahead of others and some are market leaders in any case. So they will naturally get re-rated when the volume of business starts to go up.
Right, Tushar, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. And just to revisit the point I was making on central bank, why coming out of PCA is important is for a lot of you who've tracked, while the name is Central Bank of India, it's obviously not the central bank. The central bank is the Reserve Bank, but it's got Prashant, very good history. It was supposedly the oldest Indian bank run by Indians. Parsi family ran it. They even acquired a Tata Industrial Bank and made it Central Bank of India, Madras. And a lot of people were extremely bullish. I think the IPO came in early 2000s, if my memory serves me right, because I remember that was the time when a lot of bullish bets were taken on Central Bank of India. And then it really fell by the wayside. In fact, I remember asking this to a market veteran, what's the biggest regret or the biggest mistake of his investment career, and he said that it was investments in Central Bank of India, thinking that it would be the next big thing. But now it's out of PCA, so at least that way something good.
Okay, out of PCA. That's the reason why it's rallying a whole lot today. Well, let's move on. A theme that we have been discussing and has by far been the biggest theme this year is defense stocks. Just take a look at Hindustan Aeronautics. The stock is up 100% year to date. It's a key player in this space, and it has a huge order book of over 84,000 crores. So to discuss business, the order execution timeline, the government has been pushing defense in a big way as well, mostly defense indigenization. We're joined by CB Ananthakrishnan, who's the chairman and managing director at HAL, who joins in now. Mr. Ananthakrishnan, it's a pleasure speaking with you. Thank you so much for being with us on CNBC-TV18. There's this big push coming through from the government, right? But you are sitting on an order book of around 84,000 crores, a little more than that actually. Tell us a little bit about execution timelines. What kind of capex do you have to invest? And how do you see the company grow? Because the street is clearly very excited about what all is happening in the world of defense.
Yes, ma'am. Morning. It is. Thank you for this opportunity. As far as the HAL's order book is concerned, today, as of today, it stands at around 85,000 crores. In fact, there is an accretion of another 3,000 crores during the current financial year. And the executable time frame is that between from 23-24 onwards for next 5 years. And added to that, we will also be keep getting another 15,000 crores on an annual basis of repair and overall, which will also be executed in the respective years. So all in all, the entire order book as of today will be executed in the next 5 to 6 year time frame, and along with the repair and overall order of 15,000 crores. And so, as far as the capex is concerned, we are already have the new facility established at Tumkuru for the LCH. We have gone in for that expansion, and the facility is almost ready for the additional manufacture of the LUH helicopters. And we are also having on the pipeline of almost 1,700 crores on an annual basis for the next 3 years of capex to be incurred.
Sir, good morning, Prashant here. I mean that model of the plane behind you is fitting. That's how your stock is done. It's taken off.
Sorry, Mr. Prashant. I think your
I was just saying that your stock has done very well, sir. It's flying high, at light speed. Can you hear me, sir?
Yeah.
Okay. I'll come to the question. Sorry. So repair work is still about 60% of your revenues, right?
Yeah, correct.
Okay. How will this change?
Yes, you're right.
Between manufacturing and repair, and so how will this proportion change? Because the market is betting that manufacturing is going to be the big theme, right? Import substitution. There are 300 items which are already, the government has already identified, which have to be made here. They cannot be imported, and that you will be a big beneficiary. So for you, between repair and manufacturing, how do you see things changing, and what are the implications for the P&L?
Yeah, as of now, what you say is right. It is at around 40% is of manufacturing, and the balance 60% is towards repair and overall. It will continue for the current financial year as well. But there could be, changes could start coming from the next financial year when we start executing the LCA contract, 83 LCA Mark 1A contract. Of course, the change may not be very perceptible for the next year, 23-24, but from 24-25 onwards, the ratio is expected to change, and more of manufacturing and equal amount of repair and overall will be coming. So we expect the ratio to be around 50-50 from 24-25 onwards. But as far as on the margins front is concerned, while repair and overall also gives us a better margin, manufacturing, when we increase the volumes and when the capacity is augmented and the volumes goes up, it will also match with the repair and overall margins, and we will be able to maintain the margins as of today. That EBITDA of around 24-25%, we will be able to maintain in the years to come. Even with the top line keep increasing, we will be able to continue to maintain that sort of a margin.
Okay, so you're saying that 24-25% is the EBITDA margin that you will maintain. You also spoke about how the overall order book is 85,000 crores that you're going to execute in the next 5 to 6 years, right? There's also an immediate replacement requirement that the Indian Armed Forces is having for aircrafts like the MiG-29, the Jaguar, the Mirage 2000. I just want to understand, will any of these be provided by HAL, and will that contribute to your revenues anytime in the next couple of years?
No, as of now, there is visibility. Apart from the existing order book of 82,000 crores, we have got visibility, and more or less in the next 1 to 2 years time frame horizon, around 42,000 crores of orders are likely to get concluded. And added to that, there is also visibility of around another 60,000 crore plus order in the next 3 to 5 year time frame. on the various platforms. As far as the immediate 42,000 is concerned, the orders have been, the CNC has been concluded in respect of HTT 40, which is around 8,000 crores. And in the other, in case of other platforms like ALH, additional ALH 25, and then Sukhoi, and then the engines of AL31FP, Sukhoi engines, all of this will put together another balance of almost 36,000 crores. So that will also expected to get concluded in the next 1 to 2 years. So with this 42, the existing order book of 85,000 crores plus 42,000 crores of visibility, which will get concluded in the next 1 to 2 years, and added to that the repair and overall of 15,000 crores on an annual basis, HAL order books looks quite healthy, and we will be able to sustain our growth, which we have been showing it in the past. And probably the growth could also be getting into a double-digit phase. Today we are our growth is around the 7 to 8%. We may probably achieve the double-digit growth by 24-25 onwards.
But from now all the way till about FY27, which is what you said, this current 85,000 crore order book is executable. On a run rate basis, we should expect, high single-digit kind of revenue growth on CAGR terms.
I am not. Can you just repeat the question? I think your voice
no, revenues you said could also get into growth, could also get into double-digit in a given year, in a particular year.
Yeah.
But on a run rate basis, will it be in the high single digits, sir? Is that the right way to look at it? Revenue CAGR for the next many years? Yeah.
Yeah, it will definitely be. It will be on the high single digit. I mean, in fact, by 24-25 onwards, we should be able to achieve the double-digit growth, and it will be sustainable. We will be able to keep on increasing. To start with, maybe in 24-25, it will be around 11 to 12%, and after that, we hope to achieve 15-digit growth. And it will be on a sustainable basis. We will be able to continue that sort of a growth.
Right. Mr. Anandakrishnan, is there going to be any other surprises? So the government already identified a list of 300 items, right, which will be progressively banned from being imported, so to make here. Will more items be added? Because this we know. What else can happen for the sector? Or you think, the roadmap is laid and this is now what it's going to be?
Yeah, as of now, the 300 numbers, HAL also has been quite, it has been an advantageous situation for HAL because our LCA Mark 1A, Dornier aircrafts, and then HTT 40, and added to that LUH also has been added. And we have got so much of design and development programs on the pipeline, like your IMRH, which is also being discussed, and it is on the design and development stage, and other products of HAL like this AMCA, along with ADA, we are trying to develop the AMCA. So all of this, once it is up to some developmental stage, once it is reached, probably this may also get included into the positive indigenization list, which will again be an advantageous position for HAL. Added to that, on the supply chain front of it, there has been another some 1,000 items which has been identified by the Ministry of Defense for indigenization. So which would mean that these items also, the supply chain will improve, and that will also have an impact on our profitability in the years to come. So on both sides, as a supplier and as well as a procuring, on the procurement side, both the sides we will be getting advantage when this PAL list comes into effect.
Okay. Sir, you said that there is a visibility of 42,000 crores of orders that's likely to get concluded in the next 1 to 2 years. I just wanted to understand that there was an expectation of the delivery of those 83 light combat aircrafts, the Tejas aircraft order, which was worth about 48,000 crores. Can you give us a status check on that? When is it expected? And have you added that into this order book?
Yeah. No, 42,000, it excludes that. What we are talking about, that 85,000 crores of outstanding order book, that includes your Tejas. But the 42,000 crores doesn't include your Tejas. As far as the executing time frame is concerned, 83 LCA, we will have to a T0 plus 36, which comes somewhere in March 24, should be the delivery of the first aircraft, and we are quite on task onto that, and we will be in a position, all the tests and the build of the aircraft we have started, and we will be in a position to deliver as per the scheduled delivery schedule in the contract. That is in February or March 24.
Do you think double-digit revenues can happen in this fiscal itself by FY23? I mean, I was looking at your numbers. 24,000 crores is what you've done in FY22. If you look at even a 10% growth, that's about targeting 27,000 crores of revenues. Is that a doable figure, you think?
Yeah, that is what we are looking. We wanted to give a growth of at least 8% in the current financial year as well as in the next financial year. In the current financial year, our target is somewhere around 26,500 crores, which would give us a growth of around 8% as compared to the previous financial year 2021. So this will be sustainable for the next year as well, and maybe from 24-25 onwards, we should be in a position to achieve a double-digit growth.
All right. Thank you very much, sir. Good speaking with you. Appreciate you joining us here on the program, and hope to speak with you, fairly occasionally with all that is happening in the defense sector. Thank you once again for taking out the time for us here on the channel. 10 points, by the way, lower on the Nifty. So this is flat, but off the lows, 17,806. So far, nothing kind of a day is how this is panning out to be. But things can change. We're still in the early 30-40 minutes of market open. And, this is what we have going. We'll take a quick commercial break here. I'm just looking at stocks, but the composition, etc., is still the same. Not very much has changed. Rate gain is up 7% now. I mentioned that with the 3% gain at open is almost back at, 300 rupees, 294. Other than that, you got Adani Wilmar, Patanjali, Triveni Turbine, Swaraj Engines, a few news-related stocks, amongst others, which are doing well at this point. We'll take that break. We are back. Nikhil Sahni, Vice Chairman and Managing Director at Triveni Turbines, will join us to discuss the big block deal in the company. Later, in a bit, we'll also connect with Rajneesh Kapoor of JK Cement to discuss the demand outlook for the sector. We're back in 2.